It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. We are managing your financial future, managing your financial present. Can't do much about the past, I don't think. Johnny Dean here, your podcast host. Welcome once again. Happy to have everybody here with us. I am here surrounded by financial planners, financial advisors, brain type people. Professor Plum, I hesitate to put you in the brainiac category, but I will. Simply for your ability to recall certain things that are both important and unimportant.
In this one particular area, we can play with that game. But
that's right.
You get me out of this area. No.
He's got experience.
That's true.
Definitely experience.
That's true. Professor Rick Plum, certified financial planner, CFP professional, and we've got Jonathan Savona, as promised or threatened. We talked about this last week, Professor Plum. I said I'm going to get him back in here because there are a whole bunch of different aspects of financial planning that Jonathan can address, and I'm happy to have you back in here, Jonathan. It can be
it's so much fun.
It is
Love
fun, and I'm trying to convince the other advisors who are a little shy about getting in front of a microphone to come in, and I'm gonna have you tell them how much fun it is.
Either they need to show me up, or I'm leading by example.
Well,
so
maybe
see.
either one. So our goal this year was to get more advisors on, and you are one of them, of course.
Well, these handcuffs as well. You don't take handcuffs off.
No, we don't do that. That's right. We lock the doors, and you can't get out until you do a podcast with us. Jonathan Savona, certified financial planner, professional as well. This came up a couple of different times, and I want to address the idea of taxes. Yes, we talk about taxes quite a bit on this program. Why do we talk about them? Because they can be one of the biggest drags on your portfolio. We've said this many times, Professor.
They're one of the
Plum.
biggest drags on your emotional stability at times, too.
Well, it does, and it can be, and it can cause some people who have not done tax planning, can cause them, well, first of all, it can surprise them when they've got a big tax bill, and the second thing, it can cause them to do things maybe they shouldn't do.
Or don't need to do.
So when we talk about tax management, I want to get into this with you, Jonathan. Markets, of course, been doing crazy things all year.
Mm-hmm.
We ended the year, I guess, was the high of the market December 31st?
It was real close to there.
Real close to that. So talk for a moment about some of the tax issues that people are facing right now that you've seen.
Right. Yeah, I mean, thanks for having me again. And I think what we're trying to do is have a topic on the show today that's timely, given that we've got time left in the year to plan ahead, potentially make changes if necessary. You start doing this in last couple weeks of December, and you might not have time to get done what you might need. So, and taxes are confusing. There's a lot of angles, a lot of different moving parts, levers you can pull. And so, we have some topics that have been common this year, but also we can bring up some things that happen every year, and we want to look at those. So kind of both angles on this.
Yeah. So one of the things that Professor Plum had mentioned, I think maybe the last time you were on, and we said we were going to talk about it, is the idea of estimated taxes. Now, this is I don't want this. People may not even think, well, what are you talking about, estimated taxes? Does this even affect me? But Professor Plum, it really does.
Well, for a lot of people, they were not affected by estimated taxes. They went along, they had some, their IRAs, their pensions, and they took a little bit out of those, and they were doing fine. And they've been doing that for a while. And then last year, 2020, 2021, we had very large capital gain distributions, either in mutual funds or even in individually managed portfolios, where the managers saw some writing on the wall towards the future and started changing their portfolios around a little bit to try to become a little more defensive of what was happening.
You're talking about the end of 2021?
The end of 2020 for the 2021 return that we just filed recently. So 2020 was a big year for capital gains and capital gain distributions.
Explain why, because I think people aren't aware what happens with mutual funds.
Yeah, and I can step in as well.
Yes,
so,
please.
I mean, these are pass-through instruments. You are investing along with thousands of other individuals. But if one individual down the street sells, they require the manager to sell which you own part of the fund. And so there's this drag that can happen when you don't make your own decisions as it relates to the fund itself, the withdrawals, the changes within, but you are part of the group. And so there are pass-through gains that happen. And we had 3 years of gains. It was 20, it was 21.
And everything was going real well. So the managers were being a little bit more buy and holdish than maybe in other years where when you hire a mutual fund, basically you're hiring a manager, you're putting your money into a pool, and that manager is buying stocks for a certain objective or bonds or whatever the objective is.
Because a mutual fund is a basket of stocks
or a basket of securities based on a
say.
certain objective.
Okay.
And as long as that objective is going along, some managers don't buy and sell very much. Some buy and sell a lot. It's called turnover. But even the ones that didn't buy and sell very much towards the end of 2020, they did a lot of turnover for whatever reason, like they were getting defensive or what I was talking about before. So you can create gains and potentially losses sometimes, but those don't get passed through. Only gains get passed through. The manager will create gains just by doing the business of buying and selling the securities on your behalf inside the mutual fund. But then in a year where they have a change of direction, you've got a bigger turnover, more potential capital gains being issued. Now, what we may see, and so what happened for the 2020 tax year, the 2021 tax return, the one we filed,
in April,
or the 2021 tax year, the one we filed just recently, was there was a lot of capital gain distribution. So if you've had a similar income for the past,
from mutual funds,
mutual funds, from stocks, even, people move their portfolios around. So if you've had a similar tax situation, you're retired, you've been getting your Social Security, your pension, you're taking X amount of dollars out of your IRA every year, things are pretty straightforward. You know what's happening. Right. But you also have this personal portfolio, and now all of a sudden, in some cases, you've doubled the amount of cash or income that goes on your tax return. You may have been making $50,000, $60,000 on your tax return, and you got a $40,000, $50,000 capital gain distribution, and all of a sudden you got this huge tax bill.
And you're saying, well, wait a minute, where did this come from?
And it happened a couple things. First off, the capital gain was taxable to some extent, but it also could have affected your Social Security, the taxability of your Social Security. But the thing that people really noticed it is they got mad when they had to pay their tax. They're, man, I got this big tax bill. But they could at least look at their portfolio and say, well, the portfolio is up, I guess. Yeah, all right. They could try to placate themselves that way. But then they get the estimated tax bills. They're saying, well, now I have to pay estimateds because my tax bill was so big last year. The tax preparation software or the tax preparer just assumes you're going to continue making that income that you made last year, and you're only withholding X, so you're going to have to pay estimated taxes. But you're paying estimated taxes based on that income you had last year, which may or may not be the income you have this year. And watching the markets this year, we may not have those capital gains like we did.
So as we've met with clients throughout the year, this is a reason we do ask for the tax return, so we can see
where did that income
what are the
come
details
from?
as far as where your gains were, how predictable is the income, and how much do we need to keep in mind of what's going on currently in the market. So to Rick's point, we had years and years of gains, and then all of a sudden, I don't know if you remember a year like last year where
that was a much bigger gain than normal,
very high. And so clients didn't quite understand it. And that's fair enough. The market moves quick, and then you don't know until you get your 1099 what's actually taxable. And there were no losses we could offset with
Very
at the
few
end of
people had
last
losses.
In 2021.
Right.
Yeah.
For 2021. And it's important to note what Rick said. This is after-tax investing. This is not
this is not your IRA.
IRAs and 401ks and tax-deferred accounts. That couldn't be the value of those. But now we enter a year where equity markets are down, and so we won't have potentially this gain-like year that we saw in 2021. We might even have losses to utilize.
Now, that's only in an individual portfolio. Mutual fund that has a loss doesn't get passed on to the shareholder. Only the gains get passed on to a shareholder. But I've noticed this in you mentioned experience earlier. Basically, a nice way of saying, Rick, you're really old. No. What I've seen, and whether or not it happens this year or not, I don't know. When the markets go down, the people will panic. People say, I want to sell. I want to keep what I want. So they sell their shares of the mutual fund. Well, where do they sell their shares? They basically, when you sell shares of a mutual fund, you're redeeming them back. That mutual fund company is buying your shares back from you. It's not like I'm selling my IBM shares to John Smith or something. where the company's not actually involved. With a mutual fund, the shares are being bought back by the company, by the mutual fund company. Well, where does that mutual fund company get the money to buy back the shares?
They have to give me the money.
They have to give me my share price. They're buying my share price back at the current, what they call net asset value, the current value of those shares. And so where does that mutual fund come up? Now, small redemptions here, there, 1 or 2% a year, they usually have enough cash to cover that. But if we have a little bit of a call it a run on the bank, whatever, a larger than expected distribution, redemption from a mutual fund, the mutual fund has to sell some of its existing assets to be able to raise the money to pay back or to the shareholders that are redeeming out. Well, some of those assets, they may have owned them for 5 or 10, 15
so
years.
They have
may
a lot
still have some gain in them.
Yeah,
I'm not saying no. They may have distributed most of the gain last year, but maybe they're creating, because they have to sell assets, they may be creating gain again this year for the shareholders that continue with it.
Wow.
And so you may look at your portfolio and you may say, well, I had 100,000 at the end of last year, beginning of this year, and now it's 85,000. And then in November, December, you get a capital gain distribution. You say, well, wait a minute. I didn't make any money this year.
So I think part of this is just being aware of what's going on so you can prepare.
Right.
And manage taxes. I mean, there's not a lot you can do about that part of it, but if you see that your fund that maybe you can sell and exchange into something that creates a loss, keeps you invested, depending on where you need that investment to be, you can take some control, whether the market's up or down. And so I think what's happened this year is we've tried to look realistically at the tax return to see, okay, if we don't have those gains, what other things, what else is changing on the tax return? Well, maybe your Social Security income went down. Your dividends, maybe they're the same.
How does the Social Security income go down?
And it's a convoluted, calculation of magi
taxation.
and
The taxation.
the taxation of your income.
Maybe the taxable portion of your Social Security went down. Your Social Security doesn't go down unless somebody dies, but we're talking about taxes.
Okay,
here.
that's
the
I wanted to ask the
portion of the Social Security
question because somebody would have said, "Wait, they're cutting my."
No, they're not going to cut your.
No.
The only time you can have a reduction in your Social Security is if you are subject to IRMA. We've talked about IRMA in the past. Income-related monthly adjustment amount.
I just wanted to
Good
make
point.
sure we did.
Yep.
Okay.
But
so,
the taxability of Social Security is a huge factor. Those capital gains that came in last year may have taken somebody from paying very little, if not any, taxes on their Social Security to full boat. 85% of their Social Security became taxable. Not only did they have to pay tax on the gain, but they had to pay tax on 85% of their Social Security.
Yeah, and Jonathan, you said, of course, there's not much you can do about this stuff. This is kind of all happening outside of your control, right? I mean, but,
if you're not
but
you
can plan. How do you avoid the big surprise, this tax surprise that you just didn't expect to happen in a year where the markets aren't doing too well?
Yeah, I mean, we're trying to estimate what the actual tax bill would be. And are we withholding enough from pensions, IRAs, 401ks, or do we need to increase, decrease, depending on what they're doing with their estimated? So I've found a few cases where clients have been paying those estimated taxes based on the large gains last year. And we're talking in the summertime and trying to figure out, well, or maybe just recently in the last couple of months, well, you don't need to pay those estimated taxes. We've run through a sample calculation of what your tax bill is going to look like, and you've already paid enough for the year. And so they're asking, should I pay these estimated taxes through the rest of the year? We have a September, we have a January. No, depending on how things continue to work, this is just an estimate, but you've already paid what we would think your tax bill is going to look like because you don't have that $40,000 gain that you had last year. And so the light bulb goes off, and all we're trying to do is just look at this every year. Last year, we could have looked at it and said, okay, you have $50,000 of potential gain.
You're going to need to
pay
pay
some more. We might want
to
be aware that you're going to get a big 1099 this year. Maybe you're not paying ahead because you still don't know what the market can do the last month of the year. But get ahead of it in your own mind. So some of these things you can control, some you can't.
Oh, man.
Estimated taxes are based on last year's tax bill.
Right.
And last year's tax bill for a lot of people, especially retirees, was a lot larger than normal.
Why do you have to know what your estimated tax? There are people who are saying, I don't understand why I need to estimate my taxes.
Well, Congress requires that you pay your taxes on a ongoing basis rather
So,
than
like
all
on-
in April.
on
you know.
a required minimum distribution or distribution you're taking out of IRAs, things like
Well,
that.
like when you're working, you're working, you get your paycheck. It's after some money has been withheld for taxes, and so they want to receive their money. And the big reason is they don't want you knowing how much you have to pay in April.
That's
and getting a
exactly
big-
the reason for withholding.
And if we didn't do withholding, most people wouldn't have
They
the
wouldn't
money
have
to
the
pay
money.
their taxes in April, and so we pay as we go. Now, with a paycheck, that's easy to pay as we go. We have somebody doing it for us.
They're withholding money out of it.
But once
Right.
we retire and we're taking our Social Security, and maybe we have a pension and we didn't sign up for withholding, and we have an IRA, we have to, and we're like, well, wait a minute, nobody's doing any withholding for us, and so like maybe a self-employed person who doesn't know their income, they have to do estimated. The idea is you're supposed to pay in a certain amount of money through the year to meet what they call safe harbor rules, so that you don't owe a penalty for under withholding. But most tax preparation software just looks at last year's bill
And
says
assumes it'll be the
that's-
same.
Yeah, and goes this year.
Hmm.
So if you have a wide fluctuation of income, because of a large capital gain, because of a windfall one year, and all of a sudden you're looking at your estimated taxes being really high and say, well, that was a one-time thing. I wish I could do that again, but it's not going to happen. But they're still requiring me to pay these huge, estimated taxes. Sure, I'll get them back when I file my tax return next year as a refund, but
you
I'd
don't
rather
wanna-
not give it
yeah.
to them in the first place.
And there's
So-
safe harbor rules as well.
Right. And so in a year like this, where we're expecting a lower income from capital gains, we may want to base our estimated withholding the amount that we pay in based on this year's projected dollar tax figure, not last year's tax figure.
So what you're saying is that you don't want to overpay before.
By huge amounts, no.
Well, it affects cash flow. I mean, we're talking about retirees who have a
Sure.
fixed income and they're
Absolutely.
drawing their
Where am I
savings
getting
down,
this money?
or they're asking for more. And I'm talking about, well, you might not need to take that IRA distribution because we're taking it out, taxing it this year when you're just going to get it back anyways.
Yeah.
And so it makes sense to reduce the withdrawals from the portfolio as well.
Cash flow is king at this point.
This whole, I mean, this is running circles around people's brains here.
Yeah.
There's
Right.
so much to think about. You don't want to pay more taxes than you're gonna,
Then you definitely
You
we
manage
owe.
them. Right. Well, and,
but
and
you
we-
don't know how much you're gonna owe.
Well, we hear about tax diversification. Lots of advisors will recommend, Roth conversions or after-tax investing along with pre-tax so that in retirement you can blend these things together. Well, the downside of that is when you do have this after-tax investing it could be wild from a tax situation, a
Yeah,
tax standpoint.
If all your money's in an IRA,
It's easy to manage.
You know exactly what the tax bill is going to be because you're only paying taxes on what you take out of the IRA.
Easy.
But if you've got IRA and personal investments, maybe you got a good sized portfolio in each side. You're never really sure what the taxability of that personal portfolio is going to create from year to year because some years may be big gains and some years may be, kind of like this so far. And so we might not have those capital, or we might have the capital gains. Who knows?
Yeah.
We don't know what the capital gains are going to be. So we have to, that's why. So if all you have is IRA, we know pretty much through the year what you're going to be taking. And then we do conversions whenever you feel like doing it. Sometimes earlier in the year so that the potential growth, although not so far this year, happens in the Roth rather than the traditional IRA. But when you have a large personal portfolio, you pretty much have to wait until November, December. Once your personal portfolio has realized is a tax language thing, you've created the gain. You've changed it from a paper gain to a real gain. If I buy a stock for $10 and it goes to $12, I have $2 of unrealized gain. It's still in the stock. I don't have to pay tax on it yet because it's still on paper. And between now and when I sell it, that $2 could go up more or go down and not be a gain at all. But as soon as I sell it and I lock in that $2 of gain that I just described, that becomes a realized gain. That's a real gain, and that's going to go on my tax return. And so we have to look at what's happening with the tax return before we can do our Roth conversions.
So, Jonathan, what are you doing? You're seeing this stuff as you meet with clients all the time, trying to explain this to them for people who are already thinking taxes, and they're right, are kind of completely out of their wheelhouse. What are you doing? What do you do for people to potentially? It's a tightrope you're walking, really.
I think in the end, I'm a believer that, what you know is better than what you don't know 10 years from now, 20 years from now. And so we're trying to manage for the lowest tax rate possible, if that's possible. But you have to know what levers are being pulled as you increase your income. And so whether it comes to Roth conversions or selling the employer stock, which you don't know what the price is going to do, or do we sell the rental property and realize potentially higher, values? Well, I mean, we can only be aware of what the taxes are going to be and try to assume something into the future. But 10, 15, 20 years from now, it's just so hard to manage
It's going to be different.
expectation.
But you know when you take money out of your IRA that you're going to have to pay taxes on it. I mean, that's
Right. So
IRA.
we're
much
talking.
So you have to not only know that you're going to pay taxes, but I think what you were saying is you also have to know what taking that money, adding that taxable
Right.
income to your tax return is going to do to other things, right?
Mhm. Right.
Specifically, your Social Security for retirees.
Oh, yeah.
It's a big hit for some people. They've got a nice Social Security benefit, and then they've got, maybe $20,000, $30,000 from their IRAs, and they're not paying a whole lot in taxes because a lot of their Social Security is not really taxable yet. And then they take another $20,000, $30,000, and all of a sudden, wow, my tax bill went up my income went up by like 20%, and my tax bill doubled. And it's all
They say, how can that be?
Exactly.
It's all a function
As long
of how
as you're
that
aware
tax return works.
why you did it. I mean, looking at one today, they're in their 61, 62. They're delaying Social Security, and they've got a pension and an IRA withdrawal. And so the question is, do we fill up more of the 12%? There's a little bit left there. Married, filing joint, 12%. After deductions, about 110,000. You can get up to about that
Before
much.
deductions.
But before deductions. So you've got the 12, and then you jump to 22%. But if they delayed all the way until required distribution age, it's like $175,000 potential
Gross
required
income.
distribution.
Oh, wow. That's a big one.
Depending on how the performance, goes with their investments.
Well, you can only guess.
But the question is, okay, do we bite the bullet a little bit on some of these conversions while delaying Social Security? And
Meaning, do you convert
Maybe use some
some
22.
now?
Maybe use some
Yeah,
of that
maybe
22%
22.
bracket.
But we could still be wrong because we don't know what legislation will change or credits or crisis or whatever is going to happen.
I don't know what legislation is going to be, but I'm pretty sure they're not going to reduce the brackets.
But there could be a deduction. There could be some credit
I'm
that's
not giving
created.
them-
I mean,
You never,
it
but
could
you don't know.
happen.
You don't know.
Yeah.
Back in the
You don't
90s,
know.
we never thought we'd get Roth IRAs either. We never thought we'd get $500,000 tax deduction on our home sales. Those were just unheard of. So I
Yeah.
guess it can happen.
we didn't know 2020 would have a required distribution delayed a year, and that could have created some type of, who knows? I mean, that's why I think, you deal with what you can today and don't
Yeah.
look back because you don't want to second guess yourself. You don't know what would have happened if you did the opposite in a way.
But if you've got somebody with the potential of $175,000 required minimum distribution 10 years from now,
Right.
and they're going to have income, and then they're going to have their Social Security, probably another 30, 40, 50,000 or more of Social Security. Their tax bill is going to go from where they are today to a lot higher, no matter what happens.
But the brackets do ratchet up, per year.
They've got the cost of living,
Right.
but they're also expected to sunset here in the not too distant future.
Exactly. So what do you do?
3
not
years,
knowing?
2 years,
26?
something like that.
Yeah.
January of 26, they go back to
I
the.
think
it's through 2025.
Yeah, and then so we've only got a couple more years of the.
That's the sneaky
12
way
and
to raise
22.
taxes.
Yeah.
Just sunset it. Well, wasn't my fault. Don't look at me. I realize we've thrown a lot at our listeners here today. I realize that we've, when we talk about things like taxes, we've thrown out, estimated taxes. We've talked about capital gains taxes. I think what people need to be aware of is that you could have a mutual fund, you own it personally, you could just not even pay any attention to it, and yet at the end of the year get a statement that says you owe taxes on
even though you didn't
capital
receive a
gains.
dime in cash in your bank account, you might have a taxable event.
Yeah, and I think this, correct me if I'm wrong, that this is what really catches a lot of people off guard. Is that correct?
Yeah, true. And so what you can do now, if you do have losses that you can personally offset, then sell and try to find something similar if you can do that. Get ahead of these potential gains that
Tax
can
loss
hit in December.
harvesting. Huh.
Tax
Now
loss
you have to
harvesting.
do that before the end of the year, though,
Before
correct?
December 31st.
Yep. Before the end of the year. can't do it after the fact. A Roth conversion, same deal. That you might want to fill it up because you didn't have the same income compared to last year.
So somebody with a mutual fund, they're just going along. They're haven't done anything. They haven't bought or they haven't sold anything.
Right.
They're just cruising along. They own some mutual funds, but those mutual funds have come down in value because during the course of the year, people have said, "I'm bailing out."
Well, they've come down in value because this year the underlying securities have come down in value.
Yes, well, they have. So the underlying securities have come down in value. People have sold out their funds or whatever they're doing, and so the mutual fund managers have had to raise the cash needed to pay off the people who are selling, correct?
Right, that is true.
So what they do is they have to sell shares of stock
And
within those mutual funds. Am I explaining this correctly to people?
Right.
So when they sell shares of mutual funds, they might sell shares of funds that I own because I own it.
Well, you own that mutual fund, so you own what that mutual fund owns.
So I'm a partial owner. Right. So in essence,
but
I have a gain potentially, a capital gain, even though I did absolutely nothing and didn't sell a dime's worth of fund.
Last November, you bought $100,000 worth of XYZ mutual fund for $100,000, and now it's worth, as I mentioned before, about $85,000.
Yeah.
You do not have a gain.
No.
You personally have a loss. But when you bought into that mutual fund has existing securities in the mutual fund
with a lot of potentially have a lot of gains
that they may have owned for a long time, and they may have sold some of those, and you then get the tax bill,
even though I did nothing. In fact, even though it's worth
even though you've lost money
less.
Now,
I haven't realized the loss, but it's on paper. It's
you put in my example, you put in 100, it's worth 85. And I'm going to, let's say they issue, a $2,000 or $3,000 capital gain, 2 or 3%, not a big one, but I get a bill and I have to pay tax on $2,000 or $3,000,
even though I did nothing.
That's a little salt in that wound. I mean, now it does raise your basis. So when you do sell out in the future, it's as if I invested 102 or 103,000, whatever the number
Little
was.
Consolation though. So
right
what
now,
we're saying is,
pay attention
in this podcast today, is that these things could be happening this year, maybe more so than in previous years, potentially.
What I have noticed is in big down years that we do see capital gain distributions.
Do you see that, Jonathan?
Yeah, I'm not surprised if we see it again.
And
for sure, because early in the year, there were still a lot of gains within the fund, and there were a lot of trades made first quarter of the year. And losses do not offset internally.
Internally, when the mutual fund buys and sells,
right,
they net out gains and losses, and they carry that forward to the end of the year.
So
if there is a loss net, they had more losses than gains during the year, the mutual fund then carries that loss to the next year. They don't even use the 3,000.
There you go.
They don't.
When it's gains, they issue it out to the shareholders. They have to by law.
Yeah.
And then we have to put it on. Now, the good thing is, regardless of whether they bought and sold those things within 3 minutes of each other and created the gain very quickly, capital gain distributions that go on your tax return are always considered long-term capital gains. And so we do have a preferential tax treatment for that. We do, for a lot of people, they're not paying taxes on that. Now, that brings up thing. Somebody may have, let's say they got a $10,000 long-term capital gain, but their income married filing jointly is under, $100,000. They actually don't owe taxes.
They don't have to write it.
They don't owe any
money.
Taxes. They're in a 0% long-term capital gain bracket, but their taxes go up by $8,500. Not their taxes, but their income, their taxable income goes up by $8,500, and they owe almost $1,000 in additional taxes. Oh, Jonathan was talking earlier about the levers that we can pull and the interaction between different types of income. Well, that's because as the income went up, capital gain is part of adjusted gross income. It affects how much Social Security I have to pay tax on. And now I got to pay tax on $8,500 of Social Security that I didn't pay tax on before at 12% bracket.
Well, what can you do?
Well, and as time has gone on, those brackets that Social Security taxes income has not changed either.
No,
inflation has hit.
That's the
brackets,
ratcheting down of brackets.
Not every rate with the tax system ratchets. Some do, and some haven't in 30 years.
The $3,000 capital loss limitation, that hasn't changed since basically, probably Tax Reform Act 86.
Maybe
even before that.
Which is why you can't pay attention to the headline reports of what changes are going to happen with different administrations, because they have so many angles to this.
Yeah.
And so you just need to be aware of it, manage it through your personal financial plan. That's why we look at this every year, and we're not going to get it right every time, but at least we're talking about it, bringing it up. We didn't even talk about Medicare, where Irma, income.
Well, explain, Jonathan. let's talk about that for just a moment, because people do need to understand that that's another aspect of tax management that they at least need to be aware of.
Yeah, Medicare, the premiums change depending on how your income is realized throughout any given year. And
so there's a certain premium that people pay.
Well, Medicare has a premium.
Yes.
Medicare Part B, C, and D, you pay a premium. Medicare Part A is free for most people, not everybody, but most people. And Medicare Part B has a premium. The reality is that premium that we pay, the average person pays, is 25% of the real premium that the government says that's what this insurance is really worth. We pay 25% of it.
Government pays
the
other
government
75%.
pays. Yeah, okay,
and Part D. Part B
Part D. Yeah.
And D.
Okay.
So as your income, single taxpayer, 80 to 90,000. It's a cliff. $1 over, your Medicare premium goes up by, $50, $100 a month.
If you're single at 80 or
$90,000,
Yep.
give or take.
90,000.
Married filing joint, 180,000
So
approximate.
it's double.
Of adjusted gross income.
Adjusted gross. And so $1 over, you end up at 2 years prior. So 2022, we're looking at 2020.
Yeah.
So the income you had in
2021 will affect next year's premium, and that can be dramatically different from the year
So
prior.
if I had
So all those capital gains that people got in 2021 that may have increased their overall adjusted gross income over the threshold, where now they have to next year in 2023 pay a lot more for their Medicare
and there
premium.
are certain ways to apply for the kind of a waiver on this, but it's very limited. It's really retirement is the big one.
Life-changing events, and
Reduction
having a
of
big capital
income.
gain distribution isn't what they consider
No,
life.
selling a rental property by choice, capital gains, those things don't affect. It's really reduction of income, meaning you retired, you partially
Sure.
retired. You can apply and have that year apply rather than the prior, and that would help you. So
But-
one of those
but
But
little
it'd be
known
nice
rules.
to know what these numbers are going into the year. So now we're planning 2022. We're trying to keep our income limits based on the IRMA limits so that we don't affect the 2024 Medicare premium. So the planning needs to be done ahead of time. We're looking at each year. You're looking not at what is the bracket happening. Did I jump into another tax bracket? But am I jumping off a cliff into the net investment income tax area, which is 3.8%? The IRMA,
Right.
which could be as much as $400 or $500 a month per person. Yeah,
For
of
your
addition-
Medicare
for your
premium.
Medicare premium.
Or ACA. We didn't talk about
the subsidies. People want to keep
subsidies.
their income down low enough to be
So
able to get the subsidies until they get to Medicare age.
That's a
All
good
these
strategy.
things are fun strategies to play
Well,
with.
I guess what people need to be aware of is if you mentioned a rental property. So if you've just been going along and you've had a rental property all these years and it never really affected you, and all of a sudden you sell it, so you have a big gain that 1 year, $200,000 or something, whatever it is, and you realize that gain, people need to be aware that in about 2 years, when your tax return makes it through the system, you're going to get hit.
Surprise, yeah.
Your Medicare premium for the entire year, correct?
Well,
Yep.
Is
or-
going to potentially jump very high.
Or
Unless-
selling your own home. You've been living in it for 40 years and your basis is low and you're moving in somewhere else, a retirement home or whatever. You don't have full exclusion on those gains. And so there's a lot of rules related to this step
You're
up in
over the
basis.
250. You're over the 500 of gain.
Right. You have a write-off, but with the values having gone up
Some
up
people
until
are over
up
those-
until recently.
How does anybody do this themselves?
Well, I'm hoping they don't.
I mean, I'm asking a couple of advisors here.
We both do
But-
it ourselves, and
we do it for everybody else.
yeah,
I just find whether you're retired or not,
not easy.
retired.
no.
I
It's
mean,
not easy.
you can get into a little groove where if nothing changes over a period of
Right.
5, 6, 7
Yeah.
years, you're not going to necessarily
That's
have
true.
these tax surprises,
Mhm.
correct?
Yeah.
Right.
But when certain things happen,
Every once in a while.
every once in a while, it's like a lightning bolt hit your house,
Right.
and all of a sudden there's a lot of collateral damage. And in some instances, Jonathan, you can do something about it. In other instances, you just have to bite the bullet, or what?
You can fund IRAs. Congress changed the law, a couple years ago, where now after 72,
if you're
still working, you can fund an IRA. So you have a chance to, after the year, reduce income. But there are stipulations around that, and you got to have earned income. So, these next 3 months are going to be timely for.
Right. And if you have a big personal portfolio, especially if you have a big personal portfolio invested in mutual funds, towards November, beginning of December, start going on that mutual funds website and find out what kind of a distribution they're declaring.
Yeah. Well, it's why we do also use exchange traded funds and
ETFs
individual securities, which you can control a bit more compared, with mutual funds, which have that underlying shelter, to it. But,
well, this was complicated, but very informative.
That's fun.
See, he says it too. I'm not the only one that says this is fun. He said it was
fun.
But
I'm sarcastic. You aren't sarcastic.
I was going to say, I don't think Jonathan was serious there. He said it was fun. Well, I mean, it's fun in the sense that there are ways to potentially combat this.
Yes.
But you have to know what you're doing. And tax management, as I said at the top of the show, taxes are one of the biggest drags on somebody's potential return, whether it's having to pay an extra $300 a month per person on your Medicare premium, which, there's $6,000-$7,000 out the window for that entire year. Or you wind up paying more in estimated taxes than you really needed to.
At least you get those back.
But you got to wait, and who knows? It really comes down to proper planning. And so you guys, as advisors, are on the lookout for this all year, right? I mean, is this stuff, when you meet with people, this is what you do? You talk about things like this, plan for it. Not that you can solve it in every single case, but at least try to make it less of a surprise.
Oh, yeah. We want to compare the last couple of years of tax returns, look to see what's going on in the market, what's changed in your life. And
I think people say, these taxes are so confusing, just tell me what to do.
Sometimes, yes.
I could see it. I mean, net investment income tax, we didn't really talk about, but the whole IRMA, as you said, income, Income
related
monthly adjustment amount. I always forget which letter is doubled. Monthly adjustment amount. IRMA. This is all stuff that people need to be aware of, and it can hit retirees particularly hard for those who are used to just living on an income.
And we didn't even bring up required distributions along with qualified charitable giving, which you can still do through the end of the year if you haven't taken your entire required distribution.
The QCD.
And you want to reduce your income further, then giving straight to a charity from that IRA. And so that's something to think about.
The QCD, if you're over 70 and a half, and you have to be at least to the day over 70 and a half, and you're doing charitable giving, I think you should be doing it through the qualified charitable distribution.
If you're charitably inclined and you're going to give money anyway,
of course,
and you're going to, you have a required minimum distribution to do what's called
because you might have run out of itemized deductions, meaning you're not getting the same deduction on the flip
anymore.
Side. And your grandkids are not, charity. That's not
no, an actual
kids and grandchildren.
Real charity, not a charity case, a real actual charity.
Now the QCD is for people 70 and a half and older.
But
the RMD is they changed the RMD age to 72. But they did not change the QCD age, qualified charitable distribution. It's still 70 and a half and older.
And all it means is you're sending money from a charity directly from your IRA. It doesn't come to you first and you write a check. You send it directly to the charity from your IRA. And the important thing there is that by doing it this way, it does not leave that awful footprint on your tax return.
Yeah,
right?
It wouldn't even show up.
It doesn't even show up.
As long as you know how to account for it on the tax return.
It shows up. It just needs
you have to
an
account
asterisk.
for it correctly. Now, I did have somebody contact me and say, wait a minute, I heard your podcast on QCDs, however many months ago we did, and they said, my IRA custodian wants to send me the check. But I said, no, stop the QCD. I do not want to receive the check. They say, well, that's the way we do it. So he called me and said, are they doing it wrong? It's a big outfit. I mean, it's a name that everybody would know. Yeah. I said, no, the check will be made payable to the charity. But a lot of the IRA custodians want or will send it to the individual so they can hand deliver, get the accolades, get the pat on the back, having the check sent to me and then giving it to the charity. As long as the check is made payable to the charity, is still a qualified charitable distribution.
There
Well,
you go.
just very quickly, because we're about out of time, but I've known people who go to their church every week and they give a certain amount, $50. I don't know what it is, whatever it happens
They drop
to
cash
be.
in the.
Yeah, but
or
as
check.
people stop kind of doing the cash thing, I've heard of people who say, well, here's what I would normally give through the entire year. I'd stick it in the basket. So what I'm going to do is take that number that I would give the entire year and just do it in one single
We've
swoop
done that. Yep.
from an
Yes.
IRA.
Right.
And would you suggest potentially for
Sure.
people who are old enough?
January comes along, you calculate what you need to take out, send what
For
you
many
want
people,
for the year, and
their,
you're done.
their
Yeah.
weekly donations to their church during
Yeah.
the church service is like their big charity, really, right?
You got to remind them every time you go. Well, remember, I already gave in
That's
January.
the thing. So when you pass the basket over to somebody else and say, "I already gave,"
Yeah.
I gave it the office.
QC, they should give you a little piece of paper
There
that
you
says
go.
QCD,
Yeah.
give it right
QCD,
here.
yeah.
This is
Covered,
it.
done.
Exactly. We could talk more about QCDs. Doggone it. We got so much to cover, but we're out of time. My thanks to you, Jonathan.
Thanks, John.
It's always good to have you on. Jonathan Savona, you work with very closely with Janine Stripe, who I keep saying I'm going to get back on the show.
She's just so busy.
Very hard to nail down because she's everywhere. But I'd like to get her on. But you guys all you work in tandem. How does that?
Yeah,
as
we're a team. We're definitely a team, and have our roles for the clients we have on the team.
Yeah,
So,
yeah. So, but Jonathan, certified financial planner, CFP professional, and of course Rick Plum, who's here every week. I can't get rid of this guy, but that's okay. We have a lot of fun.
We do, even off the air.
Even off the air.
Thanks, guys.
Exactly. If you want to get in touch with either one of them, you can do so at 800-644-1150. The folks at Lucia Capital Group, they're all on the same page. Everybody does this. All the plans go through Professor Plum. Jonathan, I mean, you guys talk exactly the same language. I mean, it's...
We talk a lot. He tends to get to the office earlier I do, so we talk on the phone while I'm driving in a lot.
There you go.
There you
Exactly.
go. 800-644-1150. Go online, LuciaCap, LuciaCap.com, and get all this information there. We're out of time. I know both these guys got appointments to get to. My thanks again to you guys. If you want to subscribe to the podcast, Spotify is where you do that, and we'd love to have you as a regular listener. For these two guys, Professor Plum and Jonathan Savona, I'm your podcast host, Johnny Dean. Thanks so much for listening. We will talk to you again next week.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material contains tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. Different types of investments and/or investment strategies involve varying levels of risk, and there can be no assurance that any specific investment or investment strategy will be profitable for a client's or prospective client's portfolio. Thus, investments may result in a loss of principal. Accordingly, no client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on a converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution or RMD in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. ETFs are subject to market fluctuation and the risks of their underlying investments. ETFs are subject to management fees and other expenses. Unlike mutual funds, ETF shares are bought and sold at market price, which may be higher or lower than their NAV and are not individually redeemed from the fund. Before investing, carefully consider a mutual fund or an exchange-traded fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. It is important to keep in mind that investments in fixed income products are subject to liquidity or market risk, interest rate risk, bonds ordinarily decline in price when interest rates rise and rise in price when interest rates fall, financial or credit risk, inflation or purchasing power risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. The information provided is based on current laws which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum, Jonathan Savona, and Janine Stripe are registered representatives with and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.